Hello, everybody, and welcome. As we like to do every week, we like to take a look at the past week's market activity and then, of course, bounce around the market and look for something to trade. Well, I've been a broken record now for months, but on Friday, obviously, big change. Who knows? Tweets, tariffs, all that stuff, whatever caused it, huge drop in the market. And of course, that meant that volatility spiked. So we see right here, volatility is now up at 19. It was down here below 10 for quite a few months. So this is the S&P 500. Let's just keep an eye out on this. Let's keep an eye out on the IV, 19%. Let's go to the NASDAQ. We can see here, this is at 28%. So this one really shot up. Same looking graph, but obviously a little bit more movement, so a little bit more volatility. And if we go to the Russell, our last one, you see this one is at 19. Again, same story, bounced up, graph looks very similar, but here's the story. Obviously, volatility has spiked in the market overall because of this move on Friday, and it may continue on Monday. Who knows? Nobody knows the future, right? Another tweet and the whole thing could turn around. We don't know. But anyways, when the market does this, when it spikes like this and there's a huge drop in volatility spikes, I like to jump into the indexes or indices to make a trade. And because the NASDAQ QQQ over here is the highest volatility, this is the one I'm going to go into. So we're going to make a trade in the NASDAQ, an iron condor. You can see volatility is way higher than the rest of them. So if we go to the trade page, now normally I'd be right here at 47, which would be 46 tomorrow. These are the weeklies. But I want to show you quickly why we're not going to use those. We're actually going to use these, the monthlies. And that's because of liquidity. I'm going to open both of these up. And what we're going to do is we're going to look at a couple of different strikes. So if I look here at the money strikes, so it's at 589.50. So basically 590 is the at the money, kind of where it is. You can see this is about just under 30 cents difference at the money, right? Just under 30 cents. If I go down here to the 590s, we see here this is 25. But this one over here, look at this. This is more like almost 50 cents. And now because we're going to be selling stuff that's way further out of the money, we're not going to be selling at the money strikes. We're going to go kind of way further away, either on the put side or the call side. So just for this one, we'll make it simple. We'll go as far as we can up here. 594. You can see this is about also 50 cents. 585, also about 50 cents. Over here, similar story, about 50 cents. Over here, 45 cents. So now let's go up here and look at the same thing. We're going to go basically the same amount of strikes away. You can see this is like less than 30 cents. Over here, this is 30 cents. Over here, this is 30 cents. Over here, about 30 cents. So that's why we're using this set of strike prices, this expiration cycle, because over here, I didn't pull them all up. The further away we go, the more illiquid it gets. But even in this small example, we're looking at roughly the same set of strikes. Down here, these are 50 cents wide in this expiration cycle. And here, these are closer to 30 cents wide. That's liquidity. The closer the bid-ask spread, the more liquid it is. And because this fits our rules, right, we like to be as close to 45 days as possible. The 47s will be closer, but the 40s are in our wheelhouse and they're more liquid. We're going with those. So good lesson on liquidity as to why we're using the 40-day strikes, which will be 39 tomorrow, instead of these, purely for liquidity. So I've saved us the trouble of trying to work this all out. I've pulled this up already. So let's just say this is 590 for ease of math. I'm going around, what's that, $32 down on the put side. And up here you can see I'm further away. Here I'm about $42 away. And why is that? Because I'm going to skew this upwards. Another little quick lesson. The market has dropped a lot, and it could continue to drop. But my assumption is that over the next 40-ish days, that it will begin to bounce back. Could be totally wrong, but I have to make an assumption. So what I'm doing is I'm putting the put side closer to the stock price, meaning I'm making it a little bit tighter, and I'm leaving more room for it on the upside because I think my assumption is that over the next 40 days, it will bounce back and there's a better chance it goes up eventually than way further down. Again, totally my assumption, but that's what we're doing. So tomorrow, if everything stays the same, I'm making this $3 wide as well because of the different strike prices. We are kind of stuck. There's no $2 wide strikes way far out over here. I'm stuck at 3. So if it's a $3 wide iron condor, what am I looking to collect? Well, it's 33 cents per dollar, so I'm looking to collect at least 99 cents or more for this trade for it to be valid. So tomorrow, assuming everything stays the same, I'm going way down here. I'm going way further up on the call side. I'm creating a $3 wide iron condor, and as long as I collect at least 99 cents or more in the Qs, NASDAQ, that will be my trade for tomorrow. Hello everybody, just a quick break in action here to make you all aware of the courses I have available on Udemy, which are these 5, but more importantly to let you know that these 3 right here are a 3-part series. So if you're anywhere in the mix here, now you know that Understand Options Completely is part 1, Basic Option Strategies is part 2, and Make and Manage is part 3. So you can start or continue at any level you like. The bottom 2 here can be taken at any time. They are just independent courses. If they interest you, please go ahead and take them. So you've got some knowledge now, and we know knowledge is power. But really, knowledge is only power if you use it. Otherwise, it's useless. So how do you take all this option trading knowledge and turn it into actual income? And the only way to do that is by actually trading options. As someone that's gone through the process, I know that making real trades is scary for many reasons. Not the least of which is, where do I even start? I mean, there's so many roadblocks to making trades. What stock should I trade? What direction should I choose? Which options am I buying or selling? The list seems endless, which is exactly why I created my option income alert system. So don't you think you'd be a little bit more comfortable and confident if I was right there by your side making trades with you? Where now I will be there with my real-time alerts. You'll trade side by side with me in real time as I tell you what trade to make, why we're making the trade, and more importantly, how to make the trade correctly. But making the trade's only half the battle. When to close the trade is just as important, so you'll get those closing alerts as well. Listen, you've got the knowledge now, so let's put it to use. So how do we turn your knowledge into actual income with as little risk as possible? Well, the way we do that is by offering up the option alert for only $1 for the first month. Now, the option alert itself is going to send out 2 to 3 trades in real time as I make them via text or email directly to you. And as I close these trades, you'll also get those closing alerts in real time as well. Now, if you want an even better opportunity, the Option Pro, which is the exact same alert service as the Option Income, offers up all the content I've ever made, courses, webinars, etc. Over $2,000 worth of options courses for only $19 for the first month. So the way we're going to sign up for either of these is by going to sharpertrades.com, clicking on the products section. Both of these alerts will show up. Depending on which one you prefer, you'll type in these coupon codes, and you'll either get the option alert for $1 for the first month, or the Option Pro for only $19 for the first month. Look forward to seeing you all over there soon. Take care.